Welcome. This is February 2025. Our webinar and office hours this month is on stock trading basics. So here's the agenda today. We're going to cover these 5 topics. What are stocks? How do they work? Key concepts, tools and strategies for beginners, common mistakes, and how to get started. So first, just starting off with an icebreaker. If you were given $10,000 to invest in the stock market today, what would you do with it? Of these options, what would you choose? And once you have that answer, keep it in the back of your mind as we go through this presentation and see if you still have the same answer at the end of the presentation, or if how you think of stock trading changes by the end. This presentation is going to be rather basic. If you've traded stocks before, you might pick up a thing or two. If you've never traded stocks, some of this is going to be pretty new, but we're going to keep this very high level, very accessible to anyone who might be brand new to trading stocks. So what are stocks? How do they work? So what is a stock? The stock is partial ownership of a company. So they're also referred to as equities, and equity is equality of outcome. So all owners of stock have the same outcomes, just to greater or lesser extents based on their stake in the company. So how does stock generate returns? So there are 2 ways that stocks generate returns. It's in capital appreciation and dividends. Those 2 together is the total return. Total return is normally what you would see in the stock market. For example, the S&P 500 is up 15% this year. That number is usually the total return. So we have an example here at the bottom. If you buy Apple stock at $100, now it's $150. Your investment has appreciated $50 per share. You held it for 2 years, 2% dividend annually. So that's an additional $4 on the $50 of appreciation. So your total return is $54 on that stock position. So what's the stock market? How does the stock market work? How is stock created, and how does it get into your hands as a retail investor? So when a company comes to a certain size, and it's normally a way to raise additional capital. So it's in the private market, and then they reach a certain size, they want some extra liquidity. Maybe some private owners of the company want to exit their positions, so they're going to sell on the public market. So they'll go to an investment bank. Generally, there'll be a roadshow. They'll go around and they'll sell these large lots of their company in an IPO, an initial public offering. Once that occurs, the stock is then listed on an exchange, New York Stock Exchange, the NASDAQ. There are different rules to be listed on different exchanges, but just knowing that once it's IPO'd, it's on an exchange, that's the important part. Brokers are investment banks, normal banks, and brokerage houses like Fidelity or Charles Schwab. These and other market makers go in between the exchange, like the NASDAQ, and the retail investor to provide that buy and sell function. So once a broker has an inventory of stocks, they're then able to trade with the retail investor. Or if they don't have it in their inventory, they'll go to the exchange, they'll get some, and then they'll make that transaction with you. So these last 2 slides, this is a pretty good infographic just to get it all together. First, 1 and 2 here has to do with total return. So it's the dividends that are earned by the company, and depreciation to profit. That's what traders do with their stocks and why they hold them. And then you can see this interplay between buyers, sellers, retail brokers, and then the stock exchange. That flow from the IPO to the exchange to the broker and then to the end investor. Here's the capital structure. This is important when a company goes bankrupt. When a company goes bankrupt, if a company goes bankrupt, the capital flows down this. It would be nice if it was like a champagne tower, right? So in a bankruptcy, all the capital would be liquidated, and then it would flow into the top cup, fill up the senior secured bonds, fill up the unsecured bonds, fill up the convertible, maybe subordinate debt, right? Normally, there's not enough champagne to get down to that preferred stock level, that common stock level. Normally, there's not anything in the liquidation to get to that level, so they're just totally wiped out. Section 2, key concepts in stock trading. Here's some different types of stock. As I just talked about, preferred stock and common stock. What we think of as stock is generally common stock. So you get more volatility. This is what you normally buy. If you get a price quoted to you, it'll be for the common stock, unless you're specifically looking for preferred stock. Preferred stock trades much more like a bond in that it has a fixed coupon percentage, like this graphic is showing. It doesn't have the voting rights that a common stock does, and it also has less volatility. You're getting a coupon payment with preferred stock, although there are options for participation. Then you have different themes of the company. What stage of life is the company in? Is it a growth stock? Is it growing sales quickly? Is it highly profitable? Or is it a more mature company, started to pay a dividend because that's the best way to return value to shareholders? It can't use that capital internally to generate the returns it used to, so it returns value to the shareholders via dividend. So there's some different buckets of stock. So risk and reward. We talked about risk in capital structure. Here's another pyramid shape here. There is a risk premium. So the more risk that a investment has, the higher returns that an investor will demand for that investment. Last time I talked about exploration in like the 1600s and how there was a cap on the interest that could be charged for these exploration companies, but they were not able to raise the capital that they needed. So they needed to increase the interest they were paying to investors to attract that capital. And that was because of the risk of the exploration, right? It might fail. So this pyramid here, we see financial security, bonds, cash in a cash account, safety and income, right? Corporate bonds, other income generating assets. Growth. So this is a growth stock, like tech company. Pick your tech company. Speculative stocks, option, speculation. And then this graph on the right, it's talking about modern portfolio theory, measuring risk and expected returns. It's found the efficient frontier where for a certain level of risk, you expect a certain level of return. No matter how much risk you're taking, there is only so much return assigned to that risk. Okay. When you're trading stocks, there are different types of orders that you can place. And this is like, you're in your account, you've got cash in the account, you found the stock, the ETF, the fund that you're going to buy, and you have options for usually a drop down. And it'll say like market order, limit order. There'll be a couple more, but just to keep it basic, we're going to stay with market orders and limit orders today. Market order is just go out and get that juice, right? Whatever the cost is, whatever the market has it at, go get it. So the market will then tell you, all right, yep, juice is $5. So it fills, right? Fills that order. A limit order, you're telling the market what your limit is. Buy juice if it's less than $4, right? The market says juice is $5. The order doesn't fill. It just stays open. You can normally set how long your limit orders are open for. And these are very useful, especially when there's a tight market. If there are only, let's say, 100 shares of a company available, and there's a lot of demand for those shares, the price is going to move very quickly. And you don't always see the market price. It's useful in a tight market to set the price that you're willing to take, because you might be given a price you don't want to accept otherwise. So when you buy stock, you are doing two things simultaneously. You're buying a piece of a company, and you're also buying a piece of paper. Stock prices are based on both of those things, both the underlying intrinsic value of the business and the scarcity or speculation around the piece of paper that is tied to the business. But there are other trends and influences on the paper that don't affect the business and aren't affected by what the business does. So we've sort of broken this down. So there's fundamental analysis, and this is the business itself. What are their cash flows? How are their sales doing? Of that, what's their profitability? This is all, these are fundamental analysis, fundamental metrics. And then there's technical analysis, right? How many people have been buying this stock recently? What is the trend of the sales growth? Is there a large short selling position, right? This is all technical analysis. It doesn't really have to do with the underlying business. It's much more about how the paper's trading at any given time. In technical analysis, people read charts. This is charting. So then there's the intrinsic value of the company, just fundamental. And then there's the market value of the company. So a company might have one fundamental value and the market assigns a multiple depending on the growth of the company, or whether it's a growth themed company or a value themed company, it'll give it a different multiple. These companies might be producing the same amount of cash. They might have the same revenues, but because of the way the market views the company, it's assigned a different financial value. So now we'll go into tools and strategies for beginners. First thing to understand is that the brokerage market has changed quite a bit recently. This chart shows commissions charged to retail investors over time. So this chart is only 20 years. So from 1999 to 2019. You can see in 1999, the average commission charged by Schwab was around $40 higher. Now, here we are in 2025, 6 years after this graph, it's completely flat. Brokerages, especially discount brokers, came under price pressure when Robinhood came around in 2013 and offered zero commission trading. The trend in the industry has been that asset custody is increasingly commoditized. So commoditized meaning one broker is very much like another. They're providing the same services. Quality is difficult to distinguish. So the only way they can really compete is on price. And so it's been a race to zero for a long time. And then in 2013, Robinhood put the last nail in the coffin by offering zero commission. So essential tools for trading. First, you would need a custodian. And as I alluded to, it doesn't super matter what custodian you use. They're all very similar in what they offer. Charles Schwab is the custodian I use with my clients. Fidelity and Vanguard are also very good. These are not the newest generation of brokers. There's a number of them out there, like Robinhood. These brokers have limited tools, more robust research tools, and that's the second part you really need in order to start trading stocks. You need a broker to take your order, a custodian to hold that stock once your order is filled. And then you really need to have an idea of what you're doing, or at least a theory of what you're doing. So these are some sources you can use to look up a stock you're interested in, read about it. Obviously, be cautious of what you're reading on the internet, especially news-related articles written by stock analysts. Very often these stock analysts are paid by the click that they get on a various article. And so their advice is not necessarily aligned with the prospective buyer or seller of a stock. For that, you really need to talk with a fiduciary to make sure that you're getting advice in your best interest. So FinViz is great charting tools, great kind of baseline information about a stock. Seeking Alpha is more on that, speculative stock analyst article reading. There's some good ones out there, but don't give it too much credence. Also has some pretty good data, especially if you pay for it. And then the gold standard I would use as a source of truth would be the SEC Edgar database, especially the 10K form. If you're really deep diving into a stock, and I suggest it, if you're buying any single stocks, to do deep dives and to continue to keep up with that stock. The SEC Edgar database is really good for 10Ks and 10Qs. 10K being the annual financial form, and then the 10Q being the quarterly financial form. The difference is that the 10K is audited and the 10Q is not. So there is some quality difference between the two. So here's some basic strategies you can use now that you have a broker, now that you know how to look up some different stocks. Here's how you can go about managing that portfolio, or some philosophies to keep in mind. Number one, diversification. Spread your risk. Even out the returns. One stock's up, one stock's down the same day. So you're even, right? That's the idea of diversification. And so over time, it's just a more smooth trajectory than having all your eggs in one basket. Dollar cost averaging. Dollar cost averaging is buying a set dollar amount of a stock in a set period of time. So $100 of stock X every month, no matter what the price is. So when the price is high, you're buying a few less shares. When the price is lower, you're buying a few more. And your basis in that stock evens out over time. It's also a good way to take the emotion out of buying a stock. Like, I don't want to buy it when it's too high. I don't want to buy it when it's too low. Consistently sticking by a strategy like this will lead to better results over time. Long-term investing. So all investing is long-term, right? Certainly over 6 months. Anything longer than a year also has tax advantages. So a long-term hold is over 365 days. If you sell this stock, it is then taxed at a capital gains rate. If it's less than 365 days, any profit on the sale of a stock is taxed at ordinary income rates, which are less favorable than a capital gains rate. Long-term capital gains is from 0%, 15 is most common, and then on the higher end of income, it's 20%. Short-term capital gains are taxed as ordinary income, actually, which have much less favorable taxation rates. Tax loss harvesting is something like right on the edge of basic and advanced strategy, so that a loss can offset a gain in a portfolio in any given tax year is something to be aware of. Unless you have a large stock portfolio that you're managing, there's not a huge amount of gain to be had by tax loss harvesting, but it is something to be aware of. So one good philosophy to have when starting out trading stocks is to be specific with each portfolio's goal and each strategy that you use in each portfolio, meaning silo your portfolios for what their strategy is. I was certainly guilty of this. I've seen other people do this. You just have one portfolio and you've tried a number of different things. And you can keep up for a while, but then if you ever try to look back, it's all jumbled together and you don't get any clear signal on what worked and what didn't work. So just by opening another account, any brokers will open multiple accounts for you and you can name them like tech growth, biotech growth, speculative biotech, or whatever it may be. But just keeping it siloed will help you manage the portfolio. So here are some common mistakes that you can avoid. We've all been guilty of some of these. Emotional trading. So fear and greed are the two most commonly talked about emotions when it comes to stock trading. I'm fearful the stock's going to fall. Fearful it's going to go to zero. I'm going to lose all my money. I'm greedy. I want to buy this stock. I want to buy more of it because it just keeps going up, right? It's going to make me all this money. Both of these can lead to bad outcomes. It's not taking into account the fundamentals of the business or the technicals of the stock, right? It's how we feel about it. And that may or may not be right, right? Best to back it up, get an unbiased opinion, bounce it off a professional, talk to someone. Lack of diversification. So this is a double-edged sword where if you know what you're doing, there's no reason to diversify. If you don't know what you're doing, and that's 99.9% of everyone, diversifying is the best thing you can do. So by not diversifying, you're exposing yourself to so much volatility. Certainly you can get that volatility upwards and that's like great, but it's more luck than it is skill. And then the next one is chasing trends. Those headlines that I mentioned that are essentially clickbait can certainly spur some people to chase stocks. Here are some tips to get started. Manage your risk. Have an emergency fund before buying stocks. It's much more important to cover expenses if the car breaks down, the pet gets sick. All of those things are much more important than investing in the stock market. Think long term. So you have that emergency fund. It covers you for 3 to 6 months, maybe out to a year. So that way your investments have that long pathway to appreciate, get the favorable tax treatment, and you can see if your strategies are working over time as well, right? Stick to those strategies and stick to a strategy in each portfolio, right? Stick to each strategy for a number of years. If you want to try a different strategy, open a new portfolio, try a new strategy for a number of years again. And at the end of it, you'll have learned something. And then keep learning, learn from experts, read books, listen to podcasts, people who have done it more than you, search for those experts out there, and be careful of any fake news out there. Getting advice or management, always an option, right? Reach out to your local financial planner. If you're going to be managing stocks, you should ask yourself, do I have the time, the aptitude, and the ability to manage this portfolio? Because it takes time. If you don't have the time, your outcome is going to be less favorable. Do you have the aptitude? Do you like it? Is it something you enjoy doing? And then do you have the ability? Like, do you understand all of the jargon used in the stock market? You can certainly learn this. This isn't rocket science. Even rocket science, you can go learn rocket science. It just takes time, just takes effort, and being realistic with yourself about if you have those things is important. And if you don't, no harm, no foul. Just find an expert who can help you manage it. There is a cost involved managing stocks, but like myself, I can open accounts for clients. I charge a very reasonable rate, up to 0.5% this year, 2025. My incentives are as a fiduciary, so I always act in my client's best interest. So key takeaways from today's presentation: stocks represent ownerships in companies. So it's fundamentally the company. And then it also trades based on trends in the market, a multiple on the growth of that company, how other buyers value that company. Understanding your own risk tolerance is critical. So let's say you're entering retirement, right? Stocks are much more volatile. And if you're going to be withdrawing from your portfolio within the next 3 to 5 years, having all of your assets in the stock market might not be right for you. So it's important to understand your personal risk tolerance, your time horizons, and talk with a professional about that. If you'd like to dip your toes in, just start small and diversify. Diversifying is the best way to get exposure to the market without the negative volatility of any single position. Your risk is just the market risk. Thank you for joining us. This has been our February 2025 office hours and webinar. We're here to help you take your first steps in trading stocks. So give us a call, reach out. Thanks.